Okay, good evening, everyone. Today we'll be looking at financial reporting FR, and our topic will be IAS 10, which is event after the reporting period. This topic is topic under disclosures of item in the financial statement. I would say events after the reporting period. We're talking about what are those events that will occurred after the financial statement is being prepared and authorized for issued. Now, the major objective of the standard stated on two major objectives. We said one is when an entity should adjust its financial statements for events after the reporting period. The standard talk about the period of time in which an entity should adjust for events after the reporting period. Two, the disclosures an entity should give about the date when the financial statements were authorized for issued and about events after the reporting period. Now, the first one say when an entity should adjust. Second one say when an entity should disclose an items. Now, when you look at these two major objectives, we're talking about the one that talk about adjusting and non-adjusting events. So we understand more as we continue in the course of our study. Now, this also talk about the scope. What are the scope of standard? So that IAS 10 should be applied in the accounting for the disclosures of events after the reporting period. So IAS 10 talk about should account for the disclosures and the events after the reporting period. Let's define some item in the standard. Definition of item in the standard. So what is event after the reporting period? This is a major item or things you should understand according to IAS 10. The event after the reporting period. So there are those events, both favorable and unfavorable. So events after the reporting period are events which are favorable and sometimes unfavorable that occur between the end of the reporting period. That means a financial statement must have an end, which is always the accounting period, which is 12 months, and the dates on which the financial statements are authorized for issued. There is the period within the financial statement will be authorized for issued because the financial statement is being prepared not for just for internal use. The financial statement is also for external use. And before it be published for the external for third party, it must be authorized for issued by the management. So any item that happens within that the year end of an account or the financial statement and the date in which the financial statement is being authorized for issued, we are saying that period is called event after the reporting period. So any event that occur, and such events might be categorized into two. We have the adjusting event and the non-adjusting event. So within the year end of a financial statement and the date in which it's been authorized for issued, within that two period, there are two major events that might happen, which will be categorized under adjusting event and the one which is non-adjusting event. When we say it's an adjusting event, we are saying there are those that provide further evidence of conditions that exist at the end of the reporting period. What is an adjusting event? We said those adjusting events they provide further evidence. That means the accountant or the management who prepare the statement, they have an understanding or information that a particular item might occur at the end of the reporting period. So such item is already envisaged within the course of preparing the financial statement. Then when that's because during the period where it was envisaged, maybe the actual amount was not known as a date of preparing the financial statement. So if after the reporting period the actual amount is now known, then the entity should adjust its financial statement, which is called an adjusting event. Right. The second one is those that are indicative of conditions that arose after the end of the reporting period. You're saying these ones, they don't envisage it. They happen suddenly, and they happens after the financial statement is being prepared. So they are non-adjusting events. They are non-adjusting events. The process involved in authorizing the financial statements for issued will vary depending upon the management structure, statutory requirements, and procedures followed in preparing and finalizing the financial statement. I think the standard said most companies has a different process before they can authorize the financial statement. It depends on the management style, depends on the management structure, it depends on the regulatory body that even that regulate the industry or regulate the company itself, or the procedure in which they prepare the financial statement. So each company has a different process for authorizing financial statements. Also, events after the reporting period include all events up to the date when the financial statements are authorized for issued, even if those events occurs after the public announcement of profits or other selected financial information. So let's look at this illustration. So to know the dates in which the financial statement is being authorized for issued, to know the date in financial statement is being authorized for issued. So the management of an entity complete draft financial statements for the year to 31st of December 2011 on 28th February 2012. On 18 March 2012, the Board of Directors reviews the financial statements and authorized them for issue. The entity announced its profits and selected other financial information on 19 March 2013. The financial statements are made available to shareholders and others on 1st of April 2012. The shareholders approved the financial statements at their annual meeting on 15 May 2012, and the approved financial statements are then filed with a regulatory board on 19 May 2012. So if you are asked which day is the date in which the financial statement is being authorized for issued, the date is the financial statement is authorized for issued on 18 March 2012. The date of board director authorization for issued, so is on 18 March. So whenever we are given a question under this standard, we'll be given different or series of dates. So you should wish to know the date in which a financial statement is being authorized for issued. Before you can identify that date, you must know the date or the year end of the financial statement. The year end will be date where we should be able to know, okay, the financial statement this is the year end. Then who is the board of director? They approve the financial statement to issued, not the date in which the shareholders approve it, not the date in which they make it to the public, they publicize the financial statement. So it's the date in which the financial statement is being authorized for issued. Let's look at another subheading: recognition and measurement. Now let's talk about adjusting events after the reporting period. The adjusting events. So an entity shall adjust the amount recognized in the financial statements to reflect adjusting events after the reporting period. When we say we have an adjusting event, so adjusting event, you must know the adjusting event, and you should be able to adjust the financial statement. The followings are examples of adjusting events after the reporting period that requires an entity to adjust the amount recognized in its financial statement or to recognize items that were not previously recognized. So when these items occurred, then we are told that we should adjust the financial statement, or if it was not included before, then we should now include these items. What are these items? So one, the settlement after the reporting period of a court case that confirmed that the entity had a present obligations at the end of the reporting period. We are saying when an entity has a court case, a litigation against the company during the financial statement, during the accounting period, because the entity legal practitioner might not know the actual liability they incurred. Say they will now make a provision, then maybe after the year end, the courts now be evaluate now, okay, this is the particular liability the company should pay to the to the other party. Then that amount should be adjusted with the provision made during the cost of preparing a financial statement. So the entity adjusts any previously recognized provisions related to this court case in accordance with IAS 37 provisions, contingency liability and contingent assets, or recognizes a new provision. So I say if the company already make a provision, then you can go and adjust the provision because you now have the actual amount, because provision is not an actual estimate or an actual value, so it's an estimated figure. So but when the court the court now give a particular value, amount, a particular value the company should pay the the other party, then you should now adjust for the provisions. B, the receipt of information after the reporting period indicating that an asset was impaired at the end of the reporting period, or that the amount of a previously recognized impairment loss for that asset need to be adjusted. Now, for example, the bankruptcy of a customer that occurs after the reporting period usually confirm that the customer was credit impaired at the end of the reporting period. I saying that where there is any receipt, there is any indication after the reporting period, before the financial statement is being authorized for issued, that there is particular impairment in a particular asset, then the company should adjust for impairment on that asset. Or two, the sale of inventories at the reporting period may give evidence about their net realizable value at the end of the reporting period. So the sale of the inventories after the reporting period may give evidence about their net realizable value at the end of the reporting period. I say, okay, remember that in IAS 2, an item must be valued lower of cost or net realizable value. So it should be lower of cost or net realizable value. So when you now sell an asset, or you find that the realizable value of that asset is lower after the end of the accounting period, then you should value it at the net realizable value. So you should account for the obsolescence of that inventory. Another item that warrants adjusting event is two. 3. That the determination after the reporting period of the cost of assets purchased or the proceed from sales sold before the end of the reporting period. The determination after the reporting period of the cost of assets purchased or the proceeds from assets sold before the end of the reporting period. The determination after the reporting period of the amount of profit sharing or the bonus payment if the entity had a present legal or constructive obligations at the end of the reporting period to make such payments as a result of events before that date. So when an entity has a particular profit sharing or the particular payment they want to make the particular entity or staff, so when you do not determine it after the reporting period, they should adjust for that items. So adjust for that item. So adjust for that item. The discovery of fraud or error that shows that the bank statements are incorrect. So maybe after you prepare the bank statement, you now determine before you authorize that there is particular error in the cost of preparing the bank statement. That error should go and we should adjust for that error. We should adjust for that error or fraud. Now, what is non-adjusting event? This particular event, you don't adjust for it. They may happen after the year end and before the bank statement is being authorized to issue. But when you identify these particular items, you don't adjust for your bank statement. You leave it like that. You just make a disclosure. You just make a disclosure for that particular event. We say an entity should not adjust its bank statement for a non-adjusting event after the reporting period. An example of a non-adjusting event is a decline in the fair value of investment after the end of the reporting period and before the dates on which the bank statements are authorized for issue. When we say non-adjusting event, when there is a decline in the fair value, maybe you have an investment, the value of that investment now fall after the end. You don't adjust for that fair value of that investment. You don't adjust for that fair value of that investment because you don't envisage that the fair value will drop. So you don't adjust for that investment. Examples. So the following examples after the end of the reporting period are examples of non-adjusting events. Events that may be of such importance that non-disclosure should affect the ability of users of financial statements to make proper evaluation and decisions. One, a major business combination. Maybe the company purchased another business or another company. Such particular transaction is a non-adjusting event. You don't adjust your financial statement. You just disclose it in a note. The destruction of a major production plant by a fire. Maybe there is a fire outbreak in a particular production plant. So because fire outbreak is not envisaged, you don't know if fire will happen at a particular period of time. So you don't adjust for you don't adjust the financial statement. Abnormally large changes in asset price or foreign exchange rate. Maybe there is increase in foreign exchange, maybe adverse or favorable. You don't adjust the financial statement for such changes in the foreign exchange rate. The standard also talk about dividend because dividend is a particular item which is very important in IAS 1. So dividend is also addressed under IAS 10 because normally major companies or public companies, they declare dividend. So when you declare dividend after, and declare is always declared after you prepare your statement, that is where you know, okay, you want to pay dividend. Then how you account for dividend? So we also follow this standard to account for dividend. So if an entity declare dividends to shareholders of equity instruments after the reporting period, the entity should not recognize those dividends as a liability at the end of the reporting period. So when you declare dividend, maybe after you already prepare your statement, not declare dividend, you don't recognize dividend as a liability. You are not owing the shareholder any money. It's not a liability on the company. So you don't recognize dividend as a liability. So, but if the dividends are declared after the reporting period, but before the financial statements are authorized for issued, the dividends are not recognized as a liability at the end of the reporting period because no obligation exists at the time. So dividends are disclosed in the notes in accordance with IAS 1, presentation of financial statement. So when you have such a declared dividend, you don't recognize the liability because you are not owing. There is no obligation that you are owing your shareholders. So when you declare the dividend, you don't recognize the liability. You just take it as a note. So when you now pay it, then you now adjust for it during that year, of payment, during the financial year of payment, you now account for the dividend. Now let's talk about going concern. Let's also talk about going concern. So an entity should not prepare its financial statements on a going concern basis if management determines after the reporting period that means when you are preparing the financial statement, you now discover that there is a situation that affects the going concern of the entity. You don't prepare your financial statement on a going concern basis. You must prepare it on a break-up basis, not prepare on a going concern basis, because the entity is not on a going concern. So one, it intends to liquidate the entities or to cease trading. So when there is any indication that the entity intend to liquidate, then you should prepare a financial statement on a break-up basis, not on a going concern basis. It has no realistic alternative but to do so. Now you don't have any alternative but just to liquidate or cease operation. If the going concern assumption is no longer appropriate, the IAS requires a fundamental changes in the basis of accounting rather than adjustments to the amount recognized within the original basis of accounting. So the standard say you should look for another basis of preparing a financial statement, and that basis is a break-up basis. The following disclosures are required by IAS 1 if the accounts are not prepared on the basis of the going concern assumption. 1. A note saying that the financial statements are not prepared on a going concern basis. You must state it in a note that yes, so this financial statement is not prepared on a going concern basis. You must state it in a note to the financial statement. The management is aware of material uncertainties related to an event or conditions which may cast significant doubts upon the entity's ability to continue as a going concern. So you should look at the disclosures of the standard. The standard is a very short standard, and you should be able to understand the standard. A short standard a disclosure standard. So now, what is under authorization? An entity should disclose the date when the financial statements were authorized for issued and who gave that authorization. So according to this standard, we must disclose the date in which the financial statement is authorized for issued. Okay, this is our financial year end, and this is the date in which it will be authorized for issued, and who authorized it. Is it the management? Is it the MD? Is it the board of director? If the entity's owners or others have the power to amend the financial statement after issuance, that fact must be disclosed. Now, if after the owners, the shareholders have the power to adjust any items or to change any items in the financial statement, we should also disclose the power given to the shareholders to do in doing so, in contrary to the standard. Non-adjusting event. All should we disclose under a non-adjusting event? An entity should disclose the following in respect of material non-adjusting event. The nature of the event. You must disclose the nature of the event. What is the event? You must disclose it. An estimate of its financial effect. A rough estimate of the financial effect, or a statement that such an estimate cannot be made, or any statement that okay, the management cannot estimate the financial effect of such non-adjusting events. So with this, we've come to the end of the standard. We come to the end of the standard. So which is IAS 10 event after the reporting period. See you in the next class.